Somewhere in the last 100 years, without a war, without a vote, without most people noticing, one country's currency conquered the entire world. Picture the foreign exchange trading floor of a major bank in Singapore. 3 a.m. The screens never go dark. Hundreds of currency pairs flash and shift every second. Traders speak in clipped code, buy, sell, cover, hedge. And underneath every single one of those transactions, no matter which two currencies are crossing, there is almost always a dollar somewhere in the chain. The dollar does not sleep because global commerce does not sleep. This matters because the US dollar is not just the currency of one country. It is the operating system of the entire global economy. It prices oil. It settles trade between countries that have never interacted with the United States. It sits in the vaults of central banks from Oslo to Nairobi to Jakarta. Roughly 58% of all global foreign exchange reserves are held in dollars, a share that has remained dominant for 8 consecutive decades. Here is the question that every sovereign wealth fund, every central bank, every multinational treasury department is implicitly trying to answer. Can the dollar maintain its structural dominance in a world where its rivals are larger, its debt is deeper, and its political authority is more contested than at any point since 1945? By the time this documentary ends, you will know the precise moment the dollar seized global supremacy, and why it was not the moment most people believe. You will understand the hidden mechanism that keeps the dollar dominant even when America is economically weak. And you will know what institutional signal sophisticated observers are watching right now. The one that tells them whether dollar dominance has 10 years left or 50. The answer to that last question will change how you think about every asset you own. Imagine the Mount Washington Hotel in Bretton Woods, New Hampshire. July 1944. The war in Europe is not yet over. But 730 delegates from 44 allied nations have gathered in this grand white resort hotel in the mountains. Outside, summer thunderstorms roll across the presidential range. Inside, the economic architecture of the post-war world is being assembled, deal by deal, clause by clause, in overheated conference rooms that smell of cigarette smoke and ambition. Most people believe the dollar became the world's reserve currency at Bretton Woods in 1944. That is the story in every textbook. But before we get to what happened in that hotel, we need to understand what had happened before every great currency in history. Every civilization that has ever dominated global trade has produced a dominant currency. The Roman denarius financed legions and built roads across 3 continents. The Dutch guilder became the first true paper reserve currency in history, held by merchants from Amsterdam to Batavia. The British pound sterling organized global trade for nearly 200 years, pricing commodities, settling debts, and underwriting empires from London to Calcutta. Each one rose, each one fell. But none of them, not one, ever achieved what the dollar achieved. None of them were involved in 88% of all global transactions. None of them were held as reserves by nations that openly opposed the country that issued them. The dollar is not merely the current dominant currency. It is the most dominant currency in the recorded history of money. And to understand how it became that, you need to understand what actually happened at Bretton Woods. The dollar did not become dominant because of the agreement signed at that hotel. It became dominant because of what the United States brought to that negotiation. By 1944, the United States held approximately 2/3 of all the gold in the world. Not because of the agreement. Before the agreement. The war had accelerated what the Industrial Revolution had begun. A massive transfer of global economic weight westward across the Atlantic. Britain arrived at Bretton Woods, already exhausted and indebted. The Americans arrived holding the gold. The agreement did not create dollar dominance. It ratified a dominance that already existed in the vaults. That is the real origin that most narratives skip. Bretton Woods gave America the crown. But 1971 proved the crown was real. On the night of August 15th, President Richard Nixon appeared on American television. He announced that the United States would no longer convert dollars into gold at a fixed rate. The Bretton Woods system, the architecture that had organized global finance for 27 years, ended. In a Sunday evening television address, every economist predicted the dollar would collapse. If dollars were no longer backed by gold, why would the world hold them? Because when Nixon removed the gold backing, every economist expected the crown to fall. It did not fall. And that is the moment the dollar stopped being powerful because of what backed it, and became powerful because of what had been built around it. That is a different kind of power entirely. It is the kind of power that does not need a guarantee. It is the guarantee. The dollar survived because the world needed it to survive. The infrastructure of global trade, the contracts, the payment systems, the commodity pricing, the correspondent banking networks, was all built in dollars. Dismantling it would have cost more than keeping it. Power, it turns out, is not just what you have. It is what everyone else has built around you. Consider what this moment rhymes with in the present. Today, critics of dollar dominance point to rising U.S. debt, the weaponization of dollar sanctions, and growing trade in non-dollar currencies between China, Russia, and the Gulf states. The parallel to 1971 is almost exact, a moment when the structural justification for dollar dominance appeared to weaken. And yet the dollar survived 1971, not by solving its structural problem, but because the cost of replacement was too high. The question worth sitting with is whether that logic still holds today, or whether the replacement cost has finally begun to fall. Stand at the loading dock of the Fujairah oil terminal on the eastern coast of the United Arab Emirates. Supertankers stretch to the horizon, waiting to load. The crude that fills those ships was priced in dollars this morning. It will be sold in dollars. The shipping contract is denominated in dollars. The insurance premium is calculated in dollars. And when the payment clears, whether the buyer is in China, India, South Korea, or the Netherlands, it will move through a correspondent banking system that settles ultimately in dollars. This is how dollar dominance operates in practice, not through political agreements. Through the weight of accumulated infrastructure. The Bank for International Settlements estimates that the dollar is involved in roughly 88% of all foreign exchange transactions globally. That number has barely moved in 20 years, despite repeated predictions of dollar decline. The dollar is not merely a currency. It is financial infrastructure. And financial infrastructure has a property that most assets do not. The more people use it, the more valuable it becomes, and the harder it becomes to replace. Economists call this a network effect. The dollar's network effect is the largest in the history of money. Now here's the paradox that almost no one discusses. The United States runs a persistent and structural trade deficit. It imports far more than it exports. In any normal economic logic, a country that consistently spends more than it earns should see its currency weaken over time. And yet the dollar remains the world's dominant reserve currency, precisely because America runs those deficits. This was articulated by Belgian economist Robert Triffin in 1960. It became known as the Triffin Dilemma. For the dollar to function as a global reserve currency, America must supply enough dollars to the world to lubricate global trade. The only way to supply those dollars is to run deficits, to send more dollars out than come back in. Which means the very condition that looks like American weakness, chronic deficit spending, is structurally necessary to maintain dollar dominance. And this connects directly to the geopolitics anchor domain. When nations like China or the Gulf states accumulate massive trade surpluses, they must do something with those dollars. What they do, overwhelmingly, is buy U.S. Treasury bonds, which funds the American deficit, which produces more dollars. The system is circular by design, and every participant who benefits from global trade has an incentive to keep it running. What most people never realize is that dollar dominance is not a privilege America chose. It is a burden the world imposed. America cannot simply print dollars for domestic purposes without affecting every economy on earth that holds them. When the Federal Reserve raises interest rates to control American inflation, it tightens financial conditions in every emerging market that has borrowed in dollars. The Fed makes decisions for America. The dollar makes consequences for everyone. Picture a U.S. Senate hearing room. A senator is making a speech about the national debt, now exceeding $34 trillion. The argument is familiar. America is living beyond its means. The debt is unsustainable. Creditors will eventually lose confidence. The dollar will collapse. It sounds entirely reasonable. Intelligent people believe it. Perhaps you have believed it. Here is what the data actually shows. In every major global crisis of the past 30 years, the 1997 Asian financial crisis, the 2001 dot-com collapse, the 2008 financial crisis, the 2020 pandemic shock, the dollar did not weaken. It strengthened. Every time fear enters global markets, capital flows toward dollars, not away. In September 2008, at the precise moment when American banks were collapsing and the global financial system was seizing, the dollar index rose by more than 20% over the following 6 months. The country whose financial recklessness had caused the crisis saw its currency strengthen because of it. Foreign investors needed dollars to pay back dollar-denominated debts. The Federal Reserve became effectively the lender of last resort to the entire world, extending swap lines to 14 central banks to prevent a global dollar shortage. The dollar is not strong because America is strong. The dollar is strong because the world built its financial system inside it and cannot get out. The trading floor of a London hedge fund at 7 in the morning. Portfolio managers watching 3 screens simultaneously. U.S. jobs data releasing in 90 minutes. The dollar index ticking on a second screen. Emerging market bond positions calculating in real time on a third. What happens in Washington this morning will move assets in Jakarta, Nairobi, and Sao Paulo before lunch. For a professional investor in the US or UK, dollar dominance creates a specific and measurable distortion. When the Federal Reserve raised rates aggressively from March 2022 through mid-2023, taking rates from near 0 to above 5%, the dollar strengthened against almost every other currency. In 2022, US dollar strength added an estimated 8 to 12 percentage points of additional return to unhedged dollar-denominated assets held by non-US investors. A benefit that had nothing to do with stock selection. Everything to do with which currency you were standing in. For a global investor, the dollar's structural role creates a specific allocation decision that most retail investors never consciously make, but always face. Commodities, oil, gold, copper, agricultural products, are priced in dollars globally. When the dollar strengthens, commodity prices in dollar terms often fall. Even if underlying supply and demand are completely unchanged, this is precisely what the gold anchor domain covers. Buying gold is, in part, a bet against dollar strength. Every commodity trade is implicitly a currency trade. And here is where the geopolitics anchor domain becomes critical. The BRICS nations have accelerated bilateral trade settlement in non-dollar currencies. India and Russia settled some energy trade in rupees. Saudi Arabia publicly discussed accepting yuan for oil. The de-dollarization narrative is real. But what institutional data suggests is that the pace of change is far slower than the headlines imply. Reserve currency transitions historically take decades, not years. The last one, from sterling to dollar, began in 1919 and was not complete until 1956. For an economy like Turkey, Egypt, or Argentina that has borrowed heavily in dollars, the mechanism is brutal and precise. When the dollar strengthens by 10%, the local currency cost of servicing dollar-denominated debt rises by 10% overnight, with no change in the underlying loan. In 2022, as the Fed tightened aggressively, the Turkish lira lost approximately 44% of its value against the dollar. Every Turkish company or government entity holding dollar debt saw its obligations nearly double in local currency terms. This is not a theoretical risk. It is a recurring structural consequence of the dollar system for developing economies. The dollar's dominance is not neutral. It is a daily tax on every economy that is not the United States. First intelligence point. Sophisticated observers are watching the dollar index, the DXY, in relation to Federal Reserve policy signals. The historical pattern shows that dollar strength peaks in late tightening cycles and weakens when the Fed pivots. What institutional behavior signals is that major asset allocators begin rotating from dollar-denominated cash into gold, emerging market equities, and commodities in the 6 to 12 months before a confirmed Fed pivot. The signal to watch is the spread between 2-year and 10-year Treasury yields. When that curve steepens after inversion, dollar weakness historically follows within 2 to 4 quarters. Second intelligence point. Sophisticated observers are watching the pace of central bank gold purchases. The World Gold Council data shows that central banks bought over 1,000 tons of gold in both 2022 and 2023, the two highest annual totals on record. The countries buying are overwhelmingly emerging market central banks, China, India, Turkey, Poland, diversifying away from dollar reserves at a rate that has no precedent in the post-Bretton Woods era. What this signals is not imminent dollar collapse, but a deliberate multi-decade institutional shift in reserve composition that will have compounding effects on dollar demand. Third intelligence point. Sophisticated observers are watching the expansion of bilateral trade settlement agreements outside SWIFT. The BRICS nations have accelerated discussions around alternative payment infrastructure. What the data suggests is that these systems currently handle a fraction of global trade volume and face significant technical and trust barriers. But the direction of travel is clear, and the longer dollar weaponization through sanctions continues, the stronger the institutional incentive to build alternatives becomes. Fourth intelligence point. Sophisticated observers are watching U.S. fiscal trajectory. The Congressional Budget Office projects that interest payments on the U.S. national debt will exceed defense spending within the current decade. What institutional behavior signals is that this is not yet causing reserve managers to sell dollars, but it is causing them to slow the rate of dollar accumulation. The marginal demand for dollars as a reserve asset is declining, even as the absolute stock remains dominant. That is a different and more nuanced signal than dollar collapse. It is dollar saturation. We opened this documentary with a question. Can the dollar maintain its structural dominance in a world where its rivals are larger, its debt is deeper, and its political authority is more contested? The answer the evidence produces is not the one either side of the debate wants to hear. The dollar is neither collapsing nor permanent. It is slowly, structurally, irreversibly becoming less dominant, while remaining by a wide margin the most important financial instrument in the world. That transition will take decades, but it is underway, and it will reshape every asset class it touches. The dollar's power was never about America's strength. It was about the world's inability to afford replacing it. Here's the question worth leaving with. If the cost of replacing the dollar system is falling through digital currencies, bilateral settlement agreements, and declining U.S. trade share, at what point does the calculation change? And which country, institution, or technology will be the one that finally makes replacement cheaper than continuation? If that question interests you, the full answer lives inside the Speakonomics library. Every documentary here is built for people who want to understand the world, not just watch it. Every financial system has a foundation. understanding whose foundation you are standing on, is the beginning of real financial intelligence. The world did not choose the dollar. The dollar chose the world. And the world is only now beginning to choose back.